So let's welcome in Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities. He's joining in to take some questions. Sanjeev, great to have you with us here. Thank you very much for your time. You know, in your strategy notes over the last year or so, one of the things you've always spoken about is the risk-free rate in the US and where it is and what if it stays there, what can it do? We are coming out of a Fed meeting last night where by all indications, or at least the indications from the Fed is that we are closer, if not done with this rate hiking cycle. How does that change things broadly, top-down, for a market like India?
Not much, I would say. See, I think this is pretty much priced in now that we are at peak interest rates as far as both India and US are concerned. Inflation has thankfully, looks like it has peaked in most of the developed markets, as also in India. So the chances of further rate hikes looks somewhat low now, unless until something goes dramatically wrong with inflation, which we are not expecting to at this point in time. But yeah, so interest rates are peaked. Having said that, if you compare this with where we were a year back, and also look at what could be interest rates, let's say a year later, my best sense would be we're not going back to zero for sure as far as global interest rates are concerned, which was a norm pretty much after the global financial crisis from 2008. You have had pretty much zero interest rates in most of the developed market. I would assume that nominal interest rates will settle somewhere above long-term inflation, maybe 2 to 3%. That's probably the longer-term inflation one should assume. Which means you're looking at a policy rate which could be well north of 2.5%, 3%, somewhere in that range. The more important thing is if I compare interest rates to where they were a year back and a year later, effectively we have gone from 0 to, let's say, 3 kind of a number, which means your risk-free rate is maybe higher, your WACC is higher, your cost of equity has to be naturally higher, which means multiples have to be logically lower. To that, if you add also the disruption risk which you are seeing across sectors and stocks, I would assume that you have to start pricing in somewhat lower multiples for markets going forward.
All right, the market, by the way, is handsomely rewarding good numbers. So Chola investment is now up 9%. It's at a fresh high. It's had a really smooth run this year. I mean, it's up almost 35% in 2023. So big thumbs up over there. ABB is also at a fresh 52-week high, and the street definitely likes those numbers. So the stock is up about, I think, 2% ABB, and there's more traction there. Sanjeev, hi, good morning. So this entire financial piece, right, has done pretty well, whether it's banks, whether it's NBFCs, ICICI Bank, Axis, now Chola. Has the time come, or, is it a good time to sort of be raising your allocations in this space?
Well, I think most people have already overweight the sector. We have been pretty positive on this for some time now. In the relative context, the sector still looks okay. So even if you were, let's say, sitting underweight or have missed the bus until now, I still think it's not that late to get into the financial space. Valuations are still very, very reasonable for most of the banks and NBFCs. In fact, if you look at most of the banks are trading below 2 times price to book. Most of the NBFCs, if you exclude things like Mahindra Finance or Chola, most of them are in the region of less than 1.5 times 12-month forward book. And if you look at most of the banks will now probably do about 13 to 17% ROE. Most of the NBFCs are also in that range now. So look quite okay from a valuation standpoint. Plus, as of now, we are not seeing any real challenges on either credit quality or on credit growth. The other things will slow down a little bit, going forward. But I think in the context of reasonable visibility on the compounding the book, valuations are fairly attractive.
All right. Hi, Sanjeev. Good morning. Sanjeev, when we spoke a while back, you had said that you were cautious on 2 spaces. One was the IT space. And, that's pretty much played out because the results have been disappointing and lack of triggers is a bit of a worry out there. Have you changed your stance or do you continue to remain cautious on IT? And also autos, you said that you're a little bit cautious even on that space, barring, say, tractors as a segment. You maintain that cautious view as well?
Yeah, pretty much. So IT is more of a, let's say, a 6 to 9 months call. We still have to see, how what is the extent of slowdown in the US? As of now, the US economy is still doing very well. The US Fed has signaled for now a pause. But I think the market is probably getting it wrong in the sense that it is assuming that you will see a series of rate cuts, by the Fed starting from the September policy meeting, and very quickly, within a year's time, we'll go to about 4% policy rate. I don't think that's going to happen. I suppose the US Fed will have to keep rates at current, peak levels for an extended period of time to ensure you see a proper slowdown in the economy. So now, if you look at any of the macroeconomic parameters in the US, barring the housing market, everything else is still doing very, very well, whether it is services sector, look at private earnings growth, you look at core inflation, and the labor market conditions, all very, very strong for now. So I think we still need, a period of high interest rates for the US economy to slow down, which clearly one would call the default the IT names. As far as the auto space is concerned, we have seen some bounce back in the stocks linked to lower commodity prices. But I think the space is so much ripe for disruption in the next 2 to 4 years. I think the returns of the companies are way too high. They will get eroded over a period of time as we see more competition going forward. So yeah, I would be extremely careful of the kind of multiples people are willing to give to the auto names currently.
What about the other sort of ex-auto consumer space, Sanjeev? Are we still playing too much for what we're seeing on the ground?
Yeah, in the short term, we're clearly not seeing any recovery for now. The problem seems to be affordability. You've seen massive price increase in the last 4 years now. And the compounded effect of that is, in the range of 40 to 50% higher than where they were before COVID, which means things have become unaffordable for a section of the population, and ultimately affordability matters for volume growth, and that is where the struggle is. Hopefully, prices remain now stable given input prices have stabilized. Another 1 year of wage growth. Hopefully, things start becoming more affordable. So, but I think this is still a 2 to 4 quarter phenomenon. I think consumer staples will probably start recovering ahead of consumer discretionary. And the medium-term challenges still remain. If you look at consumer durables, building materials, construction materials, you will start seeing a lot of changes in the way these products are sold. So the multiples will probably not hold in that kind of scenario. So disruption risk is very, very real in the sector too.
We are heading into a discussion with the management of Titan. So I just wanted your thoughts before we wrap this discussion with you. A very strong jewelry performance for Titan. And, this has been a consistent compounder over the years. And the management, despite all the challenges in the industry or in the economy right now, has reiterated that 20% growth is what they're going to be doing. As an investor, does that make you comfortable? How are you feeling about this space and the stock in general?
No, we are big fans of Titan. It's been there in the model portfolio for some time now. Even though the stock a little expensive at a 60 times 12-month forward basis, if you adjust for the value of some of the other businesses for more like 55 times or so, but it's still on the higher side. But having said that, it's a fantastic company. It will continue to compound earnings at around 18 to 20% for a reasonably long period of time. And I won't put past its management to deliver some surprises on some of the newer categories going forward, because they clearly have a lot of skills in execution, implementation, etc. And I think the geographical expansion into some of the developed markets, plus in South India, that seems to be the next big trigger for the stock, apart from whatever normal growth you're going to see in the jewelry segment.
Sanjay, final question before we let you go. New age companies, we briefly discussed the last time around as well. Now, besides the price correction, you have interest rates as well could have peaked out, which helps their cause. What's your view on them? Some of these businesses looking interesting. You want to give us a hint on which one?
Yeah, I think so. I think at least Zomato is starting to look a little bit more interesting because anyway, it's a play market now. And hopefully, you will start seeing more sensible competition over there. So if that happens, I don't think it is too difficult for these companies to move towards profitability going forward. In the sense, if you look at Zomato, for example, the average order value of about 400 rupees, it's not too difficult, to build in some, extra delivery charges of 2, 4, 5 rupees, which can really improve the profitability of the business going forward. In the sense, given the fact that you only have a two-player market, the market potential is fairly large. So with some moderate growth, you really don't need to spend that much on capital now. I think the path to profitability looks reasonably good over there. Other segments, we are actually quite okay with most of the names now, given the fact that valuations have come off. At least the focus of the management has now shifted, to profitability. I think that's a big change, I would say.
All right, Sanjeev, thanks a lot for all of your thoughts. Appreciate them and have a great day. Thanks for joining us on CNBC TV 18. By the way, for the